3 years ago, most people had never heard of ChatGPT, and the idea that artificial intelligence would reshape entire industries seemed like distant science fiction reserved for tech enthusiasts and futurists. Then November 2022 happened, and within months, a handful of companies exploded in value, while everyone else watched from the sidelines, wondering what they had missed. NVIDIA went from a $300 billion company to over $2 trillion in market cap. Microsoft added $1 trillion to its valuation. Early investors who positioned themselves before the mainstream caught on made the kind of generational wealth that changes family trajectories for decades. Most people missed it entirely. They heard about AI, thought it sounded interesting, maybe even played around with ChatGPT a few times, and then went back to their regular lives, without ever connecting the dots between a technological shift and an investment opportunity. By the time they realized what was happening, by the time it became obvious to everyone, the easiest money had already been made. That same pattern is unfolding right now with a technology that most people still aren't paying serious attention to, and the window to position yourself before mainstream awareness catches up is closing faster than most realize. The CEO of NVIDIA recently said something that should have made headlines everywhere, but barely registered with the general public. He said the ChatGPT moment for general robotics is just around the corner. Not in 10 years, not in 5 years, but right now, in the immediate future that we're all living through. Coming from someone who runs the company that powers most of the world's AI infrastructure, that statement carries significant weight. And the numbers emerging from the industry back him up completely. Consider what's happened with autonomous vehicles, which represent one of the most visible applications of robotics technology. In 2020, Waymo was doing maybe a few thousand driverless rides per week. Impressive as a technological demonstration, but hardly a business that anyone would consider commercially significant. By mid-2023, they had scaled to about 10,000 weekly rides across their operating cities. By the end of 2025, they crossed 450,000 weekly paid rides, which represents 45 times growth in just 2.5 years. They're now averaging over 1 million rides per month, operating nearly 2,500 robotaxis across multiple cities, and have raised over $16 billion in funding, at a valuation exceeding $125 billion. Their target for the end of 2026 is 1 million rides per week, essentially quadrupling their current weekly volume, while simultaneously expanding into 20 additional cities, including international markets like London and Tokyo. This isn't a company running pilot programs and hoping something works. This is a company operating at commercial scale with a clear path to massive expansion, and they represent just one segment of the broader robotics revolution. Amazon tells an even more striking story about what's happening behind the scenes in industrial automation. Back in 2019, Amazon had roughly 200,000 robots working across their warehouse and fulfillment network. In July 2025, they announced they had deployed their 1 millionth robot, a 5-fold increase in just 6 years. Their robot population now rivals their human workforce, which sits at around 1.5 million globally, and 75% of Amazon's deliveries now involve robotic assistance in some form. They've developed an AI system called Deep Fleet that coordinates their entire robot fleet, improving travel efficiency by 10% and enabling faster deliveries at lower cost. Their newest fulfillment center in Louisiana operates with 10 times more robots than traditional facilities and requires roughly half as many human workers to process the same volume of orders. Amazon plans to replicate this design across 40 facilities by the end of 2027, expecting to generate over $12 billion in savings from automation between 2025 and 2027. This isn't speculation about what might happen someday in some imagined future. This is happening right now, at massive scale, in companies that touch your daily life. The only question is whether you position yourself before the acceleration becomes obvious to everyone, or after, when the opportunity looks completely different. Here's why 2026 specifically represents a critical inflection point for this technology and the investment opportunities surrounding it. The Trump administration has made robotics a strategic priority, and they're backing that priority with policy action and federal resources. Commerce Secretary Howard Lutnick has been meeting directly with CEOs from Boston Dynamics, Apptronik, Tesla, and other major robotics companies. And according to multiple credible reports, the administration is preparing an executive order on robotics with a comprehensive national strategy to accelerate American development in this sector. The Department of Transportation is establishing a dedicated robotics working group. Congressional Republicans have proposed creating a National Robotics Commission as part of defense authorization legislation. The federal government is committing billions of dollars across multiple categories: autonomous military equipment, including drones and unmanned systems, manufacturing automation to support reshoring efforts, and robotics research and development to maintain competitiveness with foreign rivals. A Commerce Department spokesperson put it directly when they said, "The administration is committed to robotics and advanced manufacturing because they are central to bringing critical production back to the United States." But the policy development that may have the biggest immediate impact on investment flows happened on July 4th, 2025, when the administration signed the One Big Beautiful Bill Act into law. Buried within this massive legislation are three provisions that have quietly triggered a surge of interest in robotics from manufacturing companies across the country. The bill restored 100% bonus depreciation on equipment purchases through at least 2029. This means a $200,000 robotic system that previously would have been written off over 5 or more years can now be fully expensed in the first year of operation. Before this bill passed, bonus depreciation had been shrinking. It was down to 40% in 2025 and was on track to disappear entirely by 2027. That made automation investments risky for companies operating on thin margins because the upfront capital expenditure wouldn't generate immediate tax benefits. Now the math has completely flipped. From a pure tax efficiency standpoint, robotics and automation equipment have become some of the best capital investments a manufacturing company can make. The return on investment calculation that used to take 5 years to pencil out can now pencil out in year 1, which removes one of the biggest barriers to adoption that had been holding back American manufacturers. This matters because policy drives capital allocation at scale. When the government creates massive incentives for an industry, money flows there. Not because investors are following government directives, but because the economics suddenly favor that direction of investment. When money flows into a sector, asset prices in that sector tend to rise as competition for quality investments increases. China understood this dynamic years ago, which is why their robotics industry has achieved a lead that now threatens American competitiveness. The Chinese government has been subsidizing robotics companies for over a decade through their Made in China 2025 initiative and subsequent policy frameworks, treating robotics as a strategic national priority rather than just another industry segment. The results of that sustained commitment are genuinely staggering when you look at the actual numbers. China now has over 2 million industrial robots working in factories across the country, which represents more than half of the entire global installed base. They have roughly 4 times as many industrial robots as the United States, and the gap continues to widen. In 2024 alone, China installed 295,000 new industrial robots, representing 54% of global demand, and setting a new annual record for any country in history. What makes this even more remarkable is how quickly they achieved this position. China's robot stock doubled in just 3 years, from 1 million units in 2021 to 2 million units in 2024. For the first time ever, Chinese domestic manufacturers sold more robots than foreign manufacturers in their home market, capturing 57% market share compared to just 28% a decade earlier. They've gone from importing nearly 3/4 of their robots to producing more than half domestically. On humanoid robots specifically, the category that may represent the next major wave of robotics development, China's lead is even more pronounced. According to Morgan Stanley research, China has filed 5 times more humanoid robot patents than the United States over the past 5 years. An estimated 87 to 90% of the roughly 13,000 humanoid robots shipped globally in 2025 came from Chinese companies. Industry estimates suggest over 140 domestic Chinese manufacturers are now producing more than 330 humanoid robot models. This concentration of capability has real strategic implications. China's robot density, the number of robots per 10,000 manufacturing workers, has reached approximately 470, which now exceeds both Germany and Japan, and far surpasses the United States at roughly 295. In practical terms, Chinese factories are significantly more automated than American factories, which affects everything from production costs to manufacturing quality to supply chain resilience. The United States installed only about 34,000 industrial robots in 2024, while China installed nearly 9 times that amount. That gap explains why the federal government is now mobilizing resources toward robotics with an urgency that hasn't been seen since the early days of the space race. This isn't just about economic growth or job creation. It's about not ceding an entire technological revolution to a geopolitical competitor whose interests don't always align with ours. One analyst put it bluntly: China has become the world's central robotics power by building factories and supply chains that scale automation at unprecedented speed. And the United States is still leading in AI software while falling behind in the physical applications that actually touch the real economy. So what does all of this mean for investors trying to position themselves for what may be one of the most significant technological shifts of the coming decade? Throughout history, whenever governments commit serious resources to emerging technology sectors, early investors in those spaces tend to do very well over the medium and long term. The internet boom followed decades of government investment in networking infrastructure and research. The semiconductor industry grew with sustained defense spending on computing capabilities. The renewable energy sector expanded dramatically, with tax credits and policy support that made previously uneconomical projects suddenly viable. Robotics is now entering that same phase of government-backed acceleration, but with an added urgency driven by international competition that didn't exist in the same way for previous technological transitions. There are several different approaches to positioning yourself for this opportunity, depending on your risk tolerance, your investment timeline, and how directly you want to expose your portfolio to the robotics sector specifically. The most diversified approach involves investing through ETFs that provide exposure to the broader robotics and automation industry without requiring you to pick individual winners. BOTS, for example, holds over 50 stocks spanning robotics, automation, and autonomous vehicle companies, giving you broad exposure to the sector while distributing risk across multiple companies and sub-industries. ROBO takes an even wider approach with exposure to roughly 77 companies across the full automation spectrum, including smaller and mid-cap stocks that might have more growth potential but also carry more individual company risk. If you believe the military and defense applications will attract the most government spending in the near term, there are ETFs specifically focused on aerospace and defense companies. These would benefit from the increased spending on autonomous military equipment, drones, unmanned ground vehicles, robotic logistics systems, and other defense applications that the administration has explicitly prioritized. Given that military applications often drive early-stage development of technologies that later find commercial use, this could represent a way to invest in robotics through the defense budget channel. For investors focused on the manufacturing angle, which may see the biggest direct boost from the new tax incentives in the One Big Beautiful Bill, industrial sector ETFs provide exposure to companies that either build automation equipment or stand to benefit significantly from widespread robotics adoption across American factories. Then there's what you might call the infrastructure layer that powers all robotics, regardless of which specific companies ultimately win the commercial race. Semiconductors represent an essential component because every robot requires computing chips, and the more sophisticated the robot, the more advanced the chips it needs. Data center companies matter because robotics generates enormous quantities of data that must be processed, stored, and analyzed, whether that's sensor data from autonomous vehicles or operational data from warehouse robots coordinating their movements. AI infrastructure is crucial because physical AI, which refers to artificial intelligence embodied in robots rather than running on computers, requires substantial computing power and creates demand for the companies that provide that computational capacity. The benefit of investing at the infrastructure level is that you don't have to correctly identify which robotics companies will ultimately dominate their markets. You're instead betting on increased activity across the entire sector, which seems like a safer assumption given the trends we're observing. Some analysts have started calling 2026 the potential iPhone moment for humanoid robots, the year when they transition from laboratory curiosities and carefully staged demonstrations to actual commercial reality deployed at meaningful scale. Chinese manufacturers like UBTech, Unitree, and Kepler have already placed humanoid robots on assembly lines at electric vehicle manufacturers, including NIO and Zeekr, where they perform assembly and quality inspection tasks alongside human workers. Data from these early deployments suggests measurable productivity gains, which creates the business case for wider adoption. Whether that specific prediction about 2026 proves accurate or slightly optimistic, the capital flowing into the broader robotics space is undeniable and accelerating. Global funding for robotic startups reached record levels, exceeding $7 billion in 2024, and 2025 appears to have surpassed that figure. Investment in early-stage robotics companies in both the United States and China ran at roughly 5 to 6 times higher than investment levels in Europe, suggesting that the two technological superpowers are both racing to establish dominance in this sector. Here's what I want you to understand about opportunities like this and how they tend to unfold over time. The people who built significant wealth from the AI boom didn't necessarily predict exactly how artificial intelligence would reshape the economy or which specific applications would take off first. They didn't need to correctly forecast that ChatGPT would become the fastest-growing consumer application in history, or that enterprise AI adoption would accelerate at the pace it did. They simply recognized that something massive was happening early enough to position themselves before the mainstream caught on, and then they let time and compound growth do the rest. Right now, robotics feels to most people the way AI felt in early 2023. Interesting, but not urgent. Potentially transformative, but probably still far away. Something worth keeping an eye on, but not necessarily something requiring immediate action. The technology seems impressive when you see demonstrations, but the commercial applications still feel distant from everyday life. That perception gap between where the technology actually is and where most people think it is, that's precisely where investment opportunity tends to live. By the time a trend becomes obvious to everyone, by the time mainstream media is covering it constantly, and your coworkers are asking whether they should invest, the early stage opportunity has typically already passed. Consider how quickly the numbers have moved in just the past few years. Amazon went from 200,000 to 1 million robots in roughly 6 years, and they're planning to expand that fleet dramatically while reducing their workforce requirements by hundreds of thousands of positions. Waymo went from 10,000 to 450,000 weekly rides in 2.5 years, and is targeting another doubling or more in the next 12 months. China's robot stock doubled in 3 years, and they're now installing robots at nearly 9 times the American rate. The federal government just created the largest tax incentive for automation adoption in decades. Robotics startup funding is hitting consecutive record highs. This isn't distant future speculation about technologies that might work someday. This is current trajectory with massive tailwinds from both market forces and government policy unfolding in real time while most people remain focused on other things. Now, I want to be direct about the risks involved, because this wouldn't be responsible analysis without acknowledging them clearly. Robotics as an industry isn't profitable yet for many of the companies operating in this space, and some of them never will be. The technology is expensive to develop, difficult to deploy reliably, and requires ongoing investment in both hardware and software. Integration into existing workflows is complex and often more challenging than companies initially expect. Some robotics companies that look promising today will fail, and distinguishing winners from losers in advance is genuinely difficult, even for experts who study this sector professionally. Markets can remain disconnected from fundamentals for extended periods, meaning that even if you're right about the long-term direction of an industry, you might have to wait longer than you'd like for that correctness to be reflected in asset prices. Just because an industry has government support and favorable policy tailwinds doesn't guarantee that every company in that industry will succeed. Government-backed sectors have produced plenty of failures alongside their successes throughout history. The Trump administration could change direction on robotics policy, regulatory challenges could slow adoption rates, and competition from China could intensify in ways that benefit Chinese companies at the expense of American ones. Any number of things could unfold differently than current trends suggest, and the future has a way of surprising even the most careful analysts. The current labor market situation also creates political complexity for robotics adoption. The administration wants to bring manufacturing back to the United States, but robotics means those reshored factories might not create as many jobs as politicians promise. That tension between automation and employment could create backlash that slows policy support, and it's worth watching how that dynamic evolves. But here's the question you ultimately need to ask yourself as you think about where to allocate your attention and resources. 5 years from now, when robots are potentially everywhere, in factories and warehouses, on roads and in delivery fleets, maybe even in homes performing household tasks, will you wish you had positioned yourself before the mainstream figured out what was happening? Will you be the person who recognized the pattern repeating from the AI boom and acted on that recognition? Or will you be the person who watched from the sidelines again, wondering why these opportunities always seem obvious only in retrospect? The last major technological revolution created a new generation of millionaires and billionaires, and it did so in a remarkably short period of time. People who bought NVIDIA at $30 before the AI boom made returns that seemed impossible in traditional markets. People who recognized that artificial intelligence wasn't just hype, but represented a fundamental shift in how work gets done across virtually every industry were rewarded handsomely for that recognition. The same pattern appears to be repeating with robotics and physical AI, with many of the same dynamics that drove the first wave of AI wealth creation now emerging in a new technological domain. The infrastructure is being built at unprecedented scale. The government is committing resources with an urgency driven by international competition. The capital is flowing from venture funds and corporate treasuries into robotics companies at record rates. The adoption curves are inflecting from experimental to commercial. Most people will wait until this is obvious to everyone, until their friends are talking about robotics stocks, until mainstream financial media is running constant coverage, until the returns have already been captured by earlier investors. By then, the landscape will look completely different, and the opportunities available will be the leftovers rather than the prime picks. I'm not telling you what to do with your money because that decision always belongs to you alone, and you should always conduct your own research before investing in anything. What works for one person's financial situation might be completely wrong for another person's circumstances, and I'm not qualified to give you personalized investment advice. What I am telling you is that something genuinely significant is happening right now in robotics and automation, backed by trends that seem likely to continue accelerating. The people who recognize transformational shifts early have historically been rewarded for that recognition, while the people who wait for absolute certainty typically end up paying a premium for their caution. The ChatGPT moment for robotics isn't coming someday in the distant future when we'll all have time to prepare and position ourselves comfortably. According to the people actually building this technology, the CEOs, the engineers, the investors who have dedicated their careers to this sector, that moment is happening right now. The only question is whether you'll recognize it in time to act.